Hey everyone, it's Dave Keller here at StockCharts.com. Welcome to our live Q&A here on YouTube. I appreciate so much you joining us. We're coming to you from our podcast studio here in Redmond, Washington. Really excited about doing some more live interactive content on YouTube. Appreciate you joining, and very much will appreciate you sharing your questions as we get started. This is a Q&A driven by all of you. So anything about the financial markets, about technical indicators, particular charts or tickers that you have questions about, or anything about the Stock Charts platform, all fair game. Just let me know what you're looking at, what you're running into. And I have a chart or two just to get us sort of kicked off and sort of get the questions coming. But put the questions right in the chat as we go on, and we'll draw all those questions from all of you. Just to get things started, I'm showing what we call new Dow theory. I had a chat with Bob Pisani of CNBC yesterday, which was great. We were talking about a number of different things, but particularly about Dow theory. And he was asking about, he had mentioned Dow theory on the air, and how meaningful is that, right? Is Dow theory still a thing? Isn't it kind of antiquated? And what we talked about was traditional Dow theory, which is Dow Industrials and Dow Transports, was a very sort of new and exciting way of thinking about economic strength back 120, 130 years ago, which was looking at the producers of goods and the distributors of goods and whether they were both doing well. And when they were both breaking out, markets were strong. When one was breaking out and the other was not, that's a danger sign. We'll come back to that in a second. What I shared with him was what I call the new Dow theory, and I wrote an article back in February on StockCharts.com talking about how on this chart both the the S&P 500 and the Nasdaq Composite had both made a new swing high, and I think that's more of a modern adaptation of what Charles Dow was originally trying to do. This is more thinking of the old economy versus the new economy. Are those different sort of main parts of what makes the economy sing in 2023 both doing well? And the breakout in February, I think, was a big thumbs up that was the case. Confirmed yet again in late May. The Nasdaq Composite, of course, broke out in early May. In late May, you had the S&P 500 break to new highs as well. And so that's what's called a bullish confirmation. That tells you that both major indexes driving higher pretty strong. So what do we look for now? I would say as long as those keep making new highs, conditions are good, right? And this goes back to, a phrase we share often on Stock Charts TV, the most bullish thing the market can do is go up. So as long as the trend keeps going higher highs and higher lows, the trend is in good shape. What you look for, and I think this is where this chart can become quite actionable, what you look for is when one of them makes a new high and the other one does not. If you look back on the left side of this chart, which is the end of 2021, you can see the type of pattern I would be looking for now. November of 21 into January of 22, the S&P, of course, made a new all-time high. That's when it was around 4,800. You can look at the Nasdaq Composite actually made a lower peak. The Russell 2000 small caps made a lower peak, and a lot of measures of breadth and momentum also sloped downwards over that period. So that's what's called a bearish non-confirmation. One of the indexes making a new high, the other one not. That's not happened yet, but that's what I would be looking for to potentially develop now. Now, the issue is both of these indexes are dominated by the mega cap stocks, right? Meta, Netflix, Amazon, Apple, Microsoft, those stocks going higher are what are really driving all of these lines to the upside. So I would guess, I think one of the things I would look for, the scenario that I think will most likely play out here over the next couple of months, is that investors start to take profits. If you had some, speculative names or some industrial names or Apple or Microsoft in your portfolio, what would you probably hold on to the longest? I would guess it's those mega cap tech consumer communications names, the FANG stocks. And as long, and you'd sort of get rid of, you've unwind everything else and sort of keep those as your core position. I think what would happen there is most likely you see the S&P 500 make a lower high, the Nasdaq Composite make a newer high. I think that might be the non-confirmation that's most likely here. But that's why this chart I think is an important one to watch. Good big picture sort of way to follow overall trends and see if there's a downside rotation. But as of today, pretty good. And you can actually see on the tab here in my Google Chrome browser, as of this morning, I was writing a note for Market Misbehavior Premium members. There's about a 30-to-1 ratio of stocks making new swing highs versus new swing lows over the last week. That tells you, I think, all you need to know about the strength of the uptrend. Really appreciate this is a live Q&A, so please put your questions in the chat, and we'll get to as many as we can in our time together today. And I'll go with the first one. Acorn asks, is it not S&P making a doji or shooting star candle with runaway train moving higher than Bollinger Bands? Oh, I love that runaway train metaphor. I think that's spot on. thumbs up on that one. I think that's a great illustration of it. Let's look at the S&P chart. And we'll see what it actually looks like here. So what I like to do is do a shorter time frame like this. I have a chart called a candle focus chart, and I do that just to kind of zoom in on ACP. I actually have a little chart to focus in on this as well. So you're asking about this candle right here. Is this a doji or shooting star candle as we're in an uptrend? So couple things on this. As of this moment, is it a doji? Yes. And actually, you wouldn't call it a shooting star. You'd actually call it a gravestone doji. There you go. There's your candlestick tip of the day. This is when the open and close are even. There's very little lower shadow and a big upper shadow. So a doji kind of looks like a cross where the open and close are the same levels, and then you have this volatility during the day. If the close and open are at the bottom, that's called a gravestone doji. If it's at the top, it's called a dragonfly doji, which is a great way that Japanese traders years ago, centuries ago, really had great visualizations to sort of describe these different patterns. So that would be a gravestone doji. What you have to be a little cautious of, though, is that's still an active candle. So a lot can happen, right? As we say, there's a lot of game left. We're just after lunchtime Eastern. We have a couple more hours of trading. So if we have a big rally into the close, this would not look anything like a doji anymore. So I would be cautious about declaring a particular pattern until the candle is done. And on stock charts, we highlight the current bar if the market's open in green or in yellow, depending on what sort of data you're looking at. But that's just one caution. So if this was the close and if we ended just like this, gravestone doji is what it would be. That would suggest short-term weakness. That basically is a sign of indecision, any sort of doji. Think of it as we're in an uptrend, then the open and close are at the same level, which means we traded around, but by the end of the day, we didn't go make any further progress. That usually indicates a market that's stalled out. Next 1 to 3 bars most likely lower. So that's actually a great observation of today's candle. It's something I would look for through the remainder of the trading day. But see where we close and see if it changes the shape of that candle. Great question there. Next question, Anton Schweitzer says, are you going to post replay of Moving Average webinar? I missed it yesterday. Yes, we did a session called Moving Average Strategies for Investors. I don't have it set up. If you go to, actually I do have it set up. If you go to marketmisbehavior.com/moving average, just register for it. It's already happened, but I will make sure I put you on the list and send you the replay. I'm actually going to send it out after this Q&A is done. But thanks for asking about that. Had a great discussion about moving average strategies, why we use the 50 and 200 day, simple versus exponential, a lot of different things that hopefully you'll find helpful. Thanks, Anton, for that question. Next question, Fluff Y. Hi, David. Thanks for doing the Q&A. You're welcome. We're enjoying them, and I hope we can do them more regularly. From a technical analysis standpoint, when you put on a trade, a swing trade specifically, how do you project a profit target? What a fantastic question, and I love that. I love that thinking. So what you're getting at, which I think is pretty important, is thinking about risk versus reward, right? What's the upside potential? What's the downside potential? So if you think about any trade, and it doesn't have to be a swing trade. It could be a longer-term investment decision or a shorter-term day trading type of time frame. You always want to think about what you stand to gain and what you stand to lose. And that in trading and in technical analysis, we call that the concept of risk versus reward. Anytime you buy any risk asset, any stock or ETF or future commodity or anything like that, you are taking on additional risk, and you have the opportunity to gain. You have the opportunity for reward, but you're taking on risk to basically fund that ability to get some future return. So thinking about that is pretty helpful. There's a name I was gonna come up with. I'll do CIBR. This is the cybersecurity ETF. We had this as a poll question on social media, so it's sort of top of mind for me. So, one of the things I would think about is like in this sort of little pattern, which is more of a pennant pattern. Let's zoom in a little bit and you can see what I'm talking about here. If you're swing trading, right? So if you have sort of a choppy tape and you're sort of buying swings, you're buying short-term weakness. So let's take cybersecurity off of the lows. We break out above this peak. We pull back. We then make a new high. Let's say you see this, and you would short on that day for some reason. Again, let's just assume you did it and you think it's a good idea. What's your downside target? So I always tell people a couple different things. I would say there are a series of technical indicators that are really optimized to try to help you understand price objectives. And some of them really are more like trailing stops, like a chandelier exit comes to mind, and thinking of that as a potential, downside objective could be an interesting way to do it. I often think about key moving averages, and I'll show you a different example with ITB here in a second. But unlike the cybersecurity ETF, I always look to the left on the chart. I see where we've been, where we've come from, and then where we're going, right? So let's say today, for example, we're seeing a bit of distribution. Let's assume today this ends up being a shooting star candle and you would go short here. I would immediately look left on the chart and find that last swing low. That's usually a really good starting point, in my opinion, for analysis, because what that does is, if you're assuming that cyber is in an uptrend and you're assuming that we're making higher highs and higher lows until proven otherwise, some sort of a higher low is a really good point. So, just you saw here, we had the higher low in June. We put in this low here. So as we pull back, you sort of look for an objective just above that previous low, assuming we won't break lower, but assuming we'll kind of pull back and retest. So, a pullback into this sort of 44.50, 45 range would sort of complete that pattern. So I like to think of objectives in a way that would continue the pattern, because if that breaks, then things are getting really, really different, and you really want to revisit it. Another thing I would think is something like ITB. You find a lot of pullbacks to an ascending 50-day moving average. And so I find if this sort of pattern, which is a bearish engulfing pattern, let's say you short going into the close or the next day because you see that as a distribution, I would immediately be looking at the 50-day moving average, particularly on a stock that has had those pullbacks many, many times. I would argue right now you're getting a bit of a bearish divergence with some of the home builders. I think one of the best things that could happen if you're, if you're bullish long term, is a bit of an actionable pullback and an opportunity to buy in on short term weakness. So something like ITB, I think you get a couple of different objectives to the downside, sort of in that 80-81 range, which would be the low from early July, and also the 50-day moving average. So that's combining the fact that the trend overall, longer term trend is positive. You're expecting some short-term weakness, so keying in on previous lows and moving average support as potential downside. I think that's a good way maybe to think about that. Next question, Penty asked, do you have any plans to have real-time scanning in ACP in the future? Trust me when I tell you we have so many plans for a lot of cool things. I would love to see that. The ACP platform is really cool about it. It gives us the ability to have a blank canvas and really, I won't say unlimited possibilities, but a lot of really good possibilities. Our entire scanning engine is actually due for a major league refresh, if not redesign, and I think we're thinking of it more of like a ground-up redesign. Our current scan engine is very powerful. I would say the interface of our scan engine could use improvement. We've all sort of, as a stock charts team, agreed that that's the case, but it is incredibly powerful, and that is undeniable. For example, the scan that I just ran earlier today, to look for stocks making new swing highs, I use the scanning engine. And again, it uses drop downs to sort of build this little scan. You can hand code it if you're sort of that sort of mindset, but it has great capabilities, and the data is fantastic, and your ability to sort through those ideas is very, very good. A redesign of the scan engine, we will absolutely be thinking of ACP connected with it. What I will tell you, though, is currently in ACP, if you can build a scan using our current scan engine, you can actually look at the results real time or you can look at the results at current results as a snapshot. Whenever you run it, you can see the results live in ACP. So we got closer with this last update, being able to embed scans inside there. I'd love to be able to do real-time and even intraday scanning in ACP, and that's what's on the list for a scan engine update. We've got some pretty big developments right now. Our new market carpet is very close to completion. A completely new look for our sharp charts. There's a new design for the user interface, and actually a new engine that's going to be running those later this year. So once we get through those pretty big, meaty topics, maybe we'll get to this one next. Mike Drucker, thanks for the question. I have done CMT Level 1 so far. I don't have an economic finance degree. Are there jobs available in the sector with completed CMT certification but without a university degree? That is an interesting question. Maybe, I guess, is the question. So number one, congrats on passing CMT Level 1. I went through the CMT a couple years ago. So we'll leave it at that. I found it a transformative process. When I think about my ability to understand market dynamics before starting that program versus the year and a half of completing that program, I was a different analyst, a different investor. The way I thought about everything was changed, and I would say in a very positive way. What's great about the CMT is it's a structured way of learning the technical analysis toolkit. Now, to be honest with you, on a platform like Stock Charts, we have great free resources. So if you want to go to Chart School and start at John Murphy's beginning, and Arthur Hill and others and many others contributed content, which is sort of our way of helping you understand technical analysis, start there. But if you really want to become a dramatically improved technical analyst, something like the CMT is pretty good. What you have to remember is the CMT certification is designed for professionals. It's really designed to recognize market professionals that have not just studied the toolkit, but also have achieved some professional experience and other things to qualify for that charter. And it's modeled after the CFA in many, many ways. So, what would be possible? I would say, taking the CMT and learning the toolkit is a really good thing. And I've actually received resumes where people talk about what level that they're on, and we're able to talk about what they've learned so far, and they're in that process, so I can get an idea of where they're headed, which is pretty good. Without a university degree, that's a tough one, though. And I would say if that's where you're at, practical experience that you can have trading, that you can have writing commentary in 2023, there are opportunities. You have more of a megaphone than ever to analyze markets and share your ideas and build a following. I would encourage you to start there and then find people that are really interested in what you're doing and your style of approach. Opportunities will probably come after that. I'd certainly love to see what you put out. If you do start a blog, let me know where it's at. Speedy Car Wash, thanks for the question. David, can we access on Stock Charts your $BPSPY chart? It's actually BPSPX because it's the bullish percent for the S&P 500 index, and 100% yes, you can do it. The easiest way, to be honest with you, is go to the articles tab on stockcharts.com. You will find my blog up here, which is called The Mindful Investor. Or you can click on my name down there below, and at the very top, there's this gray button that says Live Chart List. I call this the Mindful Investor Live Chart List. This is a group of charts that I actually keep updated. It's actually looking at one of the chart lists that I have in my Stock Charts login. Anytime I update the charts there, they're refreshed on that list. So if you go to that link, just save this link, you'll be able to get right to this thing. And again, once you get there, if you click on Save to Chart List, you can actually take the current charts and save them. As long as you're a Stock Charts member, which you all should be, of course, you click on that, you can save them as your own chart list, and then they're your own charts. So they won't update anymore from my updates, but you can save your own annotations. You can edit them, tweak them, do whatever you want to do. And so that's where I would do it. And on this list, if we go down just a little bit, I start with some big picture stuff, and then I get into breadth, and this is the chart you're asking about right here, which is the S&P bullish percent index. And again, if you click on this chart right from here, you can save it to your own chart list. That's the way that I would do it. This is a really interesting chart, by the way, and I've mentioned this recently on the air and in some articles, because I think going back to the intro, when we talked about Dow theory, the reality is the market's going up. We know that. The reality is the breadth had been pretty meager earlier in 2023 and is now becoming more and more strong, right? More and more significant. And that is undeniable as well. And I think it's not because technology keeps working. It's because other sectors like industrials and materials and some energy and financials are all sort of bouncing higher, getting above moving averages, breaking above swing highs, and that's what's causing these breadth indicators to now be very, very strong. So I was connecting with Ryan Dietrich, who pointed out, yeah, this is good, right? That means everything's kind of going up, and I would agree. For me, when it feels like everything's going up, which I think we're kind of there, you look for signs that that's changing. That's why with Dow theory or new Dow theory, you look for a non-confirmation. That's why with the bullish percent index, which is now almost at 80%, you look for it to break back below 70. And I've highlighted in red the previous times over the last 18 months where we've broken above 70 and come back below. It's pretty much all the major swing highs, not necessarily the top, right? But it's a peak where we have a meaningful drawdown afterwards. So for now, it's telling you conditions are good. Look for a break below that 70% level. That would tell me conditions are no longer ideal, but for now, pretty good. So that's how you can get to it. And the ticker is $BPSPX if you want to come into that on your own. Next question, Acorn again. For commodities like natural gas, would you use UNG or the continuous future contract? ETFs trade 6.5 hours versus 23 hours for futures, so gaps in contango not obvious with UNG. That is a brilliant question. And I will tell you, when I first learned about ETFs, this is early 2000s, I'd started the industry, ETFs were still not particularly liquid outside of like the majors, right? Most ETFs were actually pretty lightly traded, but I immediately found that the indicative prices you got, right, sort of the indications, your ability to recognize shifts in trend and recognize momentum and how different asset classes and sectors and industries are all related, way upgraded once you had ETFs. Because when you're looking at a commodity and an index future and an equity and a currency, talk about apples versus oranges in so many ways. Because of some of the things you mentioned, the trading hours are different. The closes might be at a different point. It's kind of pretty weird. With a group of ETFs, everything's the same, right? Same open, same close, same closing price, same, potentially you think of it as one community of investors rotating between those ETFs. So it's a much more, I think, consistent way of recognizing changes. And I think that's the benefit of something like of UNG, right? If you look at the natural gas fund, is it a perfect representation of the natural gas future, NG1 or whatever sort of future contract you'd look at? No. Is it really close? Yeah. And I would say for something like crude oil, I look at USO way more often because I think it's a great indication of oil prices today. The difference is if you're looking at a longer term time frame, and I think that's where something like UNG or USO can become very disconnected from the underlying commodity. That's where you want to look at future and commodity prices more directly. By the way, I appreciate that question because I was talking with Julius DeKempener, who's helping us redesign our whole data strategy here. And one of the things we've just looked at recently is commodities, futures, all sorts of different types of everything I just said. We have a small amount of data now. We will have a much bigger, richer database of those futures and commodities areas very, very soon. I wish I could tell you more, and as soon as they're unleashed, I'll give you more details about it. But look for more and more data that we have. That's a big strategic focus in 2023. Folks, that was all the time we had for Q&A. That was fun. I love to do this again. I'm on vacation next week, taking the family to the Disney World in Florida, going to the other corner of the continent. But we'll do this again, hopefully the week after. I hope you can come back and ask more questions. The markets, of course, will probably be very, very different 2 weeks from now, but hopefully that'll give us a lot of questions to do. Thanks again for joining us live, and we'll see you for the final bar. We're coming up at later today on Stock Charts TV. Have a good one.